Not every money laundering case runs through a bank. Some of the most complex schemes in history required a different kind of infrastructure. Professionals and businesses that operate just outside the financial system. The FATF calls them DNFBPs, designated non-financial businesses and professions. The category includes real estate agents, lawyers, notaries, accountants, trust and company service providers, dealers in precious metals and stones, and casinos. They are not banks. But they control access, legitimacy, and legal cover. That is why the FATF calls them gatekeepers. And why, without proper controls, they become the criminals' preferred infrastructure. The Hendricks case shows exactly how DNFBPs are exploited. Kurt Hendricks, a Russian national, laundered nearly $4 million through California real estate. He used a corporate nominee, a multi-tiered structure of shell companies, wire transfers from accounts in Latvia and Switzerland, and a corporate entity incorporated in the British Virgin Islands. The ecosystem included a real estate agent, a lawyer, a TCSP, and an accountant, none of whom were subject to mandatory AML obligations. No single actor saw the full picture. That was the design. The key takeaway for the exam. Complex laundering schemes often require more than one DNFBP to execute, each contributing one layer of the structure. Casinos are not classified as financial institutions, but they provide quasi-financial services. They accept funds on account, exchange currency, facilitate transfers, and offer stored value instruments. That exposure makes them placement vehicles. Illicit cash enters through chip purchases and is commingled with legitimate gaming revenue. Online casinos add a different risk: remote onboarding, high-risk jurisdictions, and VPN use that bypasses geolocation controls. Then there are junkets, sponsored trips that bring high-net-worth individuals to casinos. Junket operators refer clients but rarely collect or share KYC details. That gap between the junket operator and the casino is where transparency breaks down. Cross-border funds. No source of wealth documented. Organized crime in the referral chain. For the exam, casinos are placement vehicles. Junkets are the gap in the gatekeeper chain. Make sure to know both for your exam. Real estate is one of the most effective vehicles for integrating criminal proceeds. A property is purchased, held, then sold. And the paper trail of legitimate sale documentation fully legitimizes the funds. But real estate is not always integration. If a property is bought and sold rapidly, that is layering, creating distance, not permanence. Integration happens when the property is held. The exam tests whether you can tell the difference. The red flags are specific: cash purchases in markets where financing is the norm, corporate or trust buyers with no justification, buyers from high-risk jurisdictions with no local presence, and buyers indifferent to the property's condition, focused only on speed of transaction. Properties that change hands frequently should also raise suspicion. 3 professional sectors sit at the center of the most sophisticated laundering structures: lawyers, accountants, trust and company service providers. A lawyer who creates a trust or shell company shields a criminal behind legal privilege. The exam question is, was the lawyer witting, knowingly complicit, or unwitting, deceived into facilitating the crime? Accountants validate transactions. When an accountant certifies funds are legitimate, the criminal gains credibility, or, if knowing, protection. TCSPs are the structural architects. They incorporate shell companies, create layered trusts, and provide nominee directors. The Panama Papers made this visible at scale: millions of offshore structures, created legally, to obscure the ultimate beneficial owner. In many jurisdictions, all 3 sectors remain self-regulated. That gap is exactly what criminals exploit. High-value portable assets, diamonds, art, gold, luxury watches, jade, convert criminal proceeds into objects. Objects that can be transported, gifted, or resold. With each transaction, the trail grows colder. The Goodwish Jade case illustrates this precisely. A Jade retailer processed large cash transactions during late-night hours. The buyers were managers from the owner's other businesses, earning monthly salaries of around $2,500. The amount spent on Jade made no sense for their income. The AML officer escalated. Suspected source: drug trafficking and prostitution from the owner's sauna parlors and nightclubs. The mechanism: criminal proceeds converted into portable assets. The exam red flag: above-market cash payment. Combined with price insensitivity and amounts inconsistent with the customer's known profile. Trade-based money laundering, TBML, moves criminal value through legitimate trade transactions. By manipulating invoices, customs declarations, and pricing. The goods are real. The paperwork is falsified. 6 core techniques: under-invoicing, over-invoicing, multiple invoicing. Short shipping, over-shipping, and ghost shipping, where no goods move at all. The Lebanese Canadian Bank case defines the typology. The bank processed flows for a Hezbollah-linked network using used car exports from the U.S. to West Africa. Legitimate invoices. Criminal proceeds underneath. The U.S. Treasury designated the bank in 2011. It collapsed. Free trade zones amplify these risks. 4,500 zones across 130 countries. Minimal oversight, weak AML, reduced customs inspection. FATF and the EU have both flagged them as systemically weak. Charities operate on public trust, move funds internationally, work heavily in cash. And in many jurisdictions face minimal AML oversight. That combination makes them attractive for placement, and for terrorist financing. Where genuine donors may unknowingly fund armed groups. The exam principle: the trust itself is the vulnerability. The charity does not need to be corrupt, only uncontrolled. Alternative remittance systems work on the same logic. An ARS moves value outside the banking system. No SWIFT, no license, no correspondent account. The best known form is hawala. ARS operators are not MSBs. They operate informally, often legally in their jurisdiction, but outside the AML perimeter entirely. For every DNFBP scenario on the exam, identify the sector, identify the mechanism. And identify where the KYC obligation breaks down. That is the complete analytical framework.